Hey everyone, this is Kirk here again at Option Alpha. So in this video, we're going to talk about partial assignments when you are trading 0DTE contracts. This is going to happen when the stock or the underlying lands partially inside of a spread. So inside of one leg, but not outside of the other leg, which actually did recently happen to me. And I'll kind of walk through why I like trading SPX better than SPY, because to me, this gap risk that you could have, this kind of landing in between two legs, is just a risk I don't want to accept if I'm going to be trading some 0DTE contracts. So here's why I like SPX. So just a quick comparison. We have this up on our Learn pages and handbook inside of Option Alpha, so you can always check this out. I'll put a link to this article in the bottom of this video, but just a quick comparison here for SPX versus SPY. As a reminder, if you're trading 0DTE contracts where things are moving very fast and then you get to expiration at the end of every single day, this might be a big consideration for you, as it is for me, as to which product you might want to trade. So first one here is SPX. Of course, this tracks the S&P 500 index. It is an index type option. The important thing here with SPX is that the settlement is to cash. So it's cash settlement and it's European style. And what that means with European style is that you can't even do the settlement process until, or the assignment process, exercise process, whatever you want to call it, you can't even do that until actual expiration. So even if you're trading an SPX contract, by the way, that's 20 days out or 30 days out, nothing can happen until physically expiration itself. So that's what it means by the European style. And then right here, the settlement type is cash, which means that there's no actual shares. Like you can't actually trade SPX. You can't trade the index itself or the ticker symbol SPX as an underlying. You can't buy 100 shares of SPX. It's just not possible. So what it means is that when you actually get to expiration, the actual profit and loss just plainly settles to cash. And again, I'm going to show you an example with my own live trade so you can see how this happened, because I had this happen just about a week ago where it settled in between my two legs. But the key thing here with SPX is, again, it settles directly to cash at the end of the session. If you are trading SPY, which is also very liquid as well, the thing you have to realize is that you're trading an ETF that has physical shares. And so it tracks 1/10 of the SPX. It's an ETF. Again, it has physical shares and physical settlement, which means that when you get to expiration, or potentially even before expiration if they get assigned early, you are going to be dealt the physical underlying shares. You're going to get SPY. You're going to either get long shares or short shares, however it works out. And so this is where it causes potentially a little bit of an issue if you get to this partial in the money assignment, where one leg lands in the money, but it doesn't land in the money so that the other leg offsets the one that was assigned. So you could be signed the short call leg, right? But it doesn't land long, the SPY doesn't land so that the long call leg is also assigned, and kind of those shares, net out from one another. And so the other key thing here, besides the physical settlement, is that SPY is American option style. And what that means is that if somebody on the other side of an SPY trade decides that they want to exercise their contract early, they can do that. They actually can do that ahead of expiration. Now, if you're going to be trading 0DTE contracts, it's not going to happen that 0DTE day. But if you're going to trade 1 day or 2 or 3 days, anytime there, literally the next day that you trade it, you could be randomly assigned from the other person if you're trading that and assign those shares. So again, that's a really key component here too. And then the last thing, again, just as a reminder, is that the physical delivery of shares. This means you have to buy 100 shares of SPY or 200 shares or 500 shares, however many contracts you have, times 100 shares of SPY. And it just can create not only just a headache to manage, not that it's unmanageable because you can manage it, but it also could put you in a situation where you have long shares or short shares without protection, and then you have overnight risk until you can get those shares off the next day potentially. So it just creates all kinds of issues. That's why I personally prefer to trade with SPX, just a little bit easier. So just to go through a quick example here so you can visually see it, and then I'll show you an example with my own account. But let's just say you have this short put spread that you're trading in SPX. So you've got your short put at, say, 55.80, and you've got your long put at 55.40. So beginning of the day, you open up this position, SPX is trading higher, then it dips down below your long put leg, and then it ultimately ends up coming back up. Okay, great, profitable trade. But what you want to take note of are the different zones for max profit, max loss, and then this partial zone which is really kind of the tricky part for 0DT trading. And you can find yourself in this partial zone a lot. And I've had a couple trades that have landed in this partial zone. So if you look at it like this, and we kind of overlaid some images here for the max profit zone. So if you're trading a short put spread, this is going to be your max profit zone, of course, in blue, in green. And then you've got your max loss zone here, which is down in red. And then kind of this gray area here, and it literally is a gray area because it's your partial profits, partial losses zone. This is where you have those partial profits, partial losses. And where the challenge comes in is that if you have SPY, for example, and you're trading SPY, and then the stock lands in this partial zone, well, that means that one contract is going to get, like one leg of your spread is going to get assigned, and the other one does not act as protection. So that's where it becomes really tricky. If you're trading SPX, you don't have to worry about that because it just settles to cash. You don't have to worry about any physical underlying settlement. You don't get delivery of shares. You don't have to manage shares. Your margin doesn't balloon overnight, and then that creates potentially a cascading effect down the line. So that's really the key here, is that when it goes into that zone, then it just settles to cash. Okay, so here's a look at one of my bots that I run, which is the 0DT Ninja. Doesn't have any positions today. It's still kind of out there searching and hunting, which is great. Here's a look at some of the closed positions from before. So we had a position last week that expired, and this one was, just so you can see kind of what different ones look like. This one we took in a credit of $230, and the market never got outside of our break evens that we had. So we had a nice wide iron condor here, and you can see it just settled to the full value. So that's an easy one, right? That's a winner one that settles to the full value. This one was a loser. This one we took in a credit of $240, and this one did actually settle far outside of our break-even points. And you can see the position expired in the money. The closing P&L was based on that underlying price at closing, right, which was $57.13. But look at where my position was for this particular trade here. It was $56.35 and $56.40. The stock closed at $57.13, or SPX closed at $57.13. So well above where my short call strikes were. So this actually just closed at a full debit close of $500, which means that we lost net $260. And all I'm saying here is that in this case, I didn't get assigned, and then one was assigned, one was auto exercise. No, they just settled to cash. It just happened and it was done. It was full value. That's what I do with this bot anyway. So that's kind of a look at two examples. So you got your max profit, you got your max loss. But what I did have recently happen is I had a position that expired as a partial profit, partial loss, right? So here's what happened with this one. This was an SPX Iron Condor, and specifically if you look at the call side, I was trading the 55, 95, 5600 call spread. So it was only $5 wide, so literally a very small window that SPX essentially fell into at expiration. So at expiration at the end of that day, SPX closed at 55.95.76. So literally 76 cents above my short call strike. This is that little window that could happen if you're trading 0DT contracts, where if you're trading SPY, then I don't want to take that risk of getting assigned 100 shares of SPY and not having protection for it overnight or whatever the case is until I can close it. In this case, the only thing that happened was that the contract settled for 76 cents as the debit to close, just the cash value of how deep that contract was in the money on whatever side. So in this case, it was in the money by 76 cents. So that was the debit to close that position. The long leg here was out of the money. There's no value on that one, obviously. So the only one you have to worry about is this one here, which this one settled slightly in the money by 76 cents. So the debit to close was $76. I originally took in $175 on this trade, which means if we net out that difference, you can see I was still left with a $99 closed P&L. And again, the beautiful thing for me, why I like it, is that it just happened, it was cash settled, it was done, and I can be on to the next day, or my bot can be on to the next trading day. I don't have to worry about it. I don't have to worry about dealing with assignment today, and then tomorrow, oh, it happened again, and then the next day it happens again. So I think this is why a lot of people, and why I particularly like trading SPX for 0DT, because I don't have to worry about it, especially for these partial assignments here, which can be very tricky, can cause you a lot of headache, can cause a lot of stress. Not that they can't be managed. it's just a pain in the butt to manage them. And SPX makes it a lot easier because you can just do cash settlement for these instead of doing the alternative. So hopefully this was a good example here just to kind of show you how it does happen in real life, how it happened in one of my trades, but just settles to cash. It makes it really, really easy. So if you are thinking about trading 0DT contracts, definitely consider strongly if you want to do SPX versus SPY. Like I said, all of my trades are in SPX, particularly because it's just a lot easier to get in there for liquidity. The options are super, super liquid, and the volume's definitely there. So I hope this helped out. As always, if you have any questions, let me know. And until next time, happy trading.